Here's something that doesn't add up. If AI is about to erase half the offices in America, who exactly is buying the stock of the companies building it? Because those stocks are hitting record highs every week. Tonight, the narrative war over AI and jobs, and the uncomfortable truth that both sides are selling you the same thing, your own fear. Start here. The Economist published a cover in 2026 showing office workers in suits falling into a black hole. Headline, "The Job Apocalypse." Now, most people scroll past magazine covers. Don't. Because The Economist is not BuzzFeed. It's read in central banks, in corporate boardrooms, by finance ministers. For 200 years, this magazine has preached one gospel. Technology destroys some jobs, but creates more. The loom killed weavers, created engineers. The car killed coachmen, created mechanics, dealerships, gas stations. That was the dogma. So why did it just break? Here's the proximate cause. In the 18 months before that cover, something shifted inside elite institutions, not in the data the public sees, but in the data corporate boards see. Internal HR dashboards, hiring freezes that didn't get press releases, quiet conversations with CEOs who told The Economist's editors, off the record, what they would never say on an earnings call. Now follow me, because the structural cause is bigger than any one cover. The Economist's job is to tell capital where to flow. When the magazine breaks 200 years of doctrine, it's not a prediction. It's a permission slip. Permission for boardrooms to start preparing for a world where labor matters less. The historical root goes back to 1942. Joseph Schumpeter coined the phrase, creative destruction. Capitalism, he said, doesn't grow by adding. It grows by killing the old to fund the new. The Economist has lived inside that doctrine ever since. But Schumpeter never said the quiet part out loud, that creation and destruction never happen in the same place at the same time to the same people. The destruction is yours, now. The creation is somebody else's, later. So what does this signal predict? Watch for 3 things over the next 18 months. First, central banks will start including AI labor displacement in their financial stability reports, quietly, in footnotes. Second, large insurers will start adjusting unemployment risk models, raising premiums on white-collar policies. Third, the political class will discover this issue roughly 6 months after it becomes unavoidable, and they'll arrive with solutions designed for the last crisis. None of that, by the way, tells you whether the apocalypse is real. It tells you the people who manage capital are betting it might be. Which brings us to the actual evidence. Because 70% of Americans now believe AI will make it harder to find a job. But fear isn't data. So I went looking for who's already been fired. The most important study nobody is talking about came out of Stanford's Digital Economy Lab. Researchers led by Eric Brynjolfsson got their hands on ADP payroll data. Millions of actual workers, real paychecks, not surveys. And they found something specific. In AI-exposed jobs, software development, customer service, accounting, workers aged 22 to 25 saw a 13% relative decline in employment in under 3 years. Now, here's where it gets interesting. Pause for a second. Same jobs, same companies, same software. Workers 30 and older, employment grew 6 to 12%. Read that again. AI is not killing the profession. It's killing the first rung, the entry point, the job a college graduate uses to get into the building. Why? Because the proximate cause is simple, and it's everywhere if you know what to look for. The work that AI does first, drafting code, writing tickets, summarizing emails, doing basic analysis, that's exactly the work you used to give the 23-year-old, the work that taught them the business. Senior people don't get replaced because AI can't run a meeting, can't read a room, can't take the blame. But the junior tasks? Gone. Revelio Labs tracked it. Entry-level postings down 35% since 2023. In some tech and data roles, down 67%. The structural cause is something economists call the apprenticeship collapse. Every white-collar profession in America is built on a pipeline. Junior learns, mid-level produces, senior leads. Pull out the junior layer and the pipeline doesn't shrink. It dies. 5 years from now, there is no mid-level because nobody got to be junior. 10 years from now, there's no senior. The historical rhyme is the 1980s manufacturing collapse. Detroit didn't lose all its jobs at once. It lost the entry-level shop floor first. The apprenticeships, the kid out of high school who became a foreman by 40. That pipeline died in 1985. Detroit is still paying for it in 2026. Now the forward projection. By 2028, 3 things follow. Recent grad unemployment, already at 5.7% in Q4 2025, worse than the 2008 crisis, passes 7%. 43% of grads are already underemployed. That number crosses 50. And by 2029, the first lawsuits arrive. Class actions from graduates against universities that charge $200,000 for credentials Stanford graduates themselves are calling a golden ticket devalued to bronze. But, and this is where it gets strange, another group of very smart, very rich people looked at the same economy and said, nothing is happening, and they have data too. Andreessen Horowitz, A16Z, one of the most powerful venture capital funds in the world, billions invested directly into AI companies. They published an essay this year calling the AI job apocalypse, quote, a complete fantasy. Unhelpful marketing, bad economics, and worse history. And they're not alone. The Yale Budget Lab, April 2026. Anxiety is widespread, but remains largely speculative. The picture is one of stability, not major disruption. The Atlanta Fed surveyed firms directly. 90% or more reported no measurable AI impact over 3 years. So which is it? Apocalypse or fantasy? Here's the answer almost nobody is giving you. Both sides are right, and both sides are lying. They're right because each is showing you one slice of the elephant. Stanford is measuring 22-year-olds in coding jobs. The Atlanta Fed is measuring the average firm, including the dry cleaner, the dentist, the trucking company, where AI hasn't touched anything. Average out an earthquake with a calm afternoon, and you get mild weather. That's not data. That's malpractice. But why are they lying? That's the structural question. And Scott Galloway, NYU professor read by millions, gave the answer that stopped me cold. He pointed out something that should be on every front page. AI optimism correlates almost perfectly with wealth. Only people earning over $200,000 a year view AI as a net positive. Below that line, fear. Above it, opportunity. And then the line that names the game. Quote, the real disruption won't come from AI, but from the public watching arsonists sell smoke detectors and call it innovation. Stop. Think about that. Arsonists, selling, smoke detectors. The historical root of this framing is older than tech. It's the tobacco playbook, the oil industry playbook. Create the problem, then sell the solution, then fund the studies that say the problem doesn't exist when regulators come knocking. A16Z isn't lying because they're stupid. They're lying because their portfolio companies need 2 things at once. Investors who believe AI will replace all human labor, that's the trillion-dollar story, and regulators who believe AI is harmless. So they fund both narratives. Apocalypse for the capital raise, fantasy for the congressional hearing. Forward projection, by Q3 2027, expect the first major academic paper funded indirectly through an A16Z portfolio company claiming AI's labor impact is statistically 0. It will get cited everywhere. 6 months later, an inspector general will trace the funding. Nobody will care, because by then the IPOs have closed. Now, follow the money one layer deeper. Because there are 2 groups profiting from the fear. And the second one will surprise you. Group 1. The AI companies themselves. Sam Altman at OpenAI. Dario Amodei at Anthropic. For 2 years, both men gave interviews about how their products would erase entire job categories. Disruption, transformation, the end of work as we know it. Now, quietly, both are walking it back. Fortune reported it. Why now? Because they're eyeing IPOs. Public markets don't want to buy stock in a company that just told Congress it's going to cause mass unemployment. They want growth, productivity, optionality. So the dial gets turned down. The structural insight. Catastrophizing was never a warning. It was a sales pitch to venture capital. Galloway put it plainly. The apocalypse narrative diverts capital flows to the hyperscalers and justifies their capex. Translation: if AI is going to eat the economy, every fund manager in the world has to buy NVIDIA, Microsoft, OpenAI, or get fired. Fear isn't a side effect. Fear is the customer acquisition strategy. But here's Group 2, the one nobody talks about. The companies doing the firing. Watch what Elon Musk did. March 2025. Musk announces Tesla is growing headcount. Output per human is going to get nutty high. Sounds like AI productivity nirvana. The following month, Tesla lays off 10% of its workforce. Why? Bad sales. Demand was down. Inventory was up. Pure old-fashioned business cycle. But the headlines: AI displacement, automation wave. The proximate cause was a recession in EV demand. The narrative that ran was a robot revolution. Why? Because layoffs are bad PR. They look like greed. Unions get angry. Politicians ask questions. But it's not us. It's AI. It's inevitable. It's progress that transforms a CEO from a villain into a futurist. AI became the perfect scapegoat. Remember the Stanford data? Entry-level postings started dropping in 2023. ChatGPT had been public for 4 months. No company on Earth had integrated it into HR workflows yet. Economists who looked closely, including Brynjolfsson himself, noted the decline was largely a hiring reset after the insane 2021-2022 overhire. Companies that hired everyone during the zero-interest rate boom were just correcting. They blamed AI. Forward projection. By 2027, expect at least one major Fortune 500 CEO to be caught on a leaked earnings call explicitly telling investors to attribute layoffs to AI for narrative reasons. It will be a scandal for 48 hours. Then everyone will go back to doing it. So if both sides are selling fear, can you relax? Is the apocalypse fake? No. And this is the twist that changes everything. 2 words. Remember them. Engels Pause. England, 1780. The first industrial revolution begins. Factories rise, output explodes, GDP soars, national wealth multiplies, and the wages of ordinary workers? Flat. For 60 years, 2-3 generations of human beings worked longer hours, produced vastly more, and saw nothing extra in their pockets. Where did the wealth go? To the people who owned the factories, the capital holders. Economists named it after Friedrich Engels, who watched it happen in Manchester and never forgot it. The economy grew. The people didn't. Now, yes, it eventually corrected. Unions formed. Labor laws passed. The 8-hour day. Wages finally rose. But that, eventually, was 60 years. Entire lives lived in poverty so grandchildren could live better. Schumpeter dressed it up as creative destruction. He didn't say the quiet part. Creation and destruction never happen in the same place, at the same time, to the same people. The destruction is yours, now. The creation belongs to someone else, later. And here is what makes 2026 different from 1840. Back then, the system had decades to adapt. Universities, retraining programs, labor unions, they had time. Today, the cycle isn't generations, it's years. The institutions physically cannot keep up, which means we are heading toward 2 paths, and both of them are traps. Path 1, techno-feudalism. AI concentrates profit into a handful of hands. Everyone else gets a stipend, universal basic income. Sounds humane, but the stipend depends entirely on the willingness of those who pay it. And who pays? The corporations and the governments aligned with them. That's not freedom. That's structural dependence. paid exactly enough to keep buying, exactly as long as it's profitable to capital, not liberation. Defeat in a gift box. Path 2. Let it run free. No safety nets. But in a transition this fast, that isn't a free market. It's abandonment. The institutions won't catch up in time. So here's the third level, the personal one. Soon the world divides into two kinds of people. Those who build assets, a skill, a system, a project that works without them. And those who consume other people's assets. Scrolling feeds someone else monetizes. This isn't a morality lecture. It's the math of the new economy. Every hour you build, you invest. Every hour you scroll, you are working for free for whoever owns the feed. But, and this matters, your personal exit doesn't fix the collective problem. Millions of people working 2 jobs for rent don't have time to build assets. When that gap explodes, it hits everyone, including you. So the choice runs on 2 levels. What you do personally, and what you and everyone else demand from the people who govern us. The Economist finally said the unsaid. That isn't a prediction of apocalypse. It's a signal that time is running out. Which side of Engels' Pause will you be standing on? If this changed how you see the AI debate, subscribe. Because we're tracking the next stage of this story. The first congressional hearings on AI labor displacement, scheduled for early 2027, and the lobbying war already underway to shape them. I want to hear your prediction in the comments. Do you think entry-level white-collar hiring recovers by 2028, or are we watching the permanent end of the apprenticeship economy? Next week, the quiet deal between 3 hyperscalers and the Pentagon that nobody is reporting. Subscribe so you don't miss it.